Hello, I'm your host, John Cavendish, and welcome to Season 5 of the Amazon Strategist Show, the show that's all strategy with no hacks, no silver bullets, and no magic pills, just real practical strategies to grow your Amazon business. Today, I'm joined by none other than my friend and business partner, Rohit Nair from Assureful. So, insurance, maybe not the most exciting topic ever, but it's one thing that to save you money, and we're talking about strategy here, because at the end of the day, we can either make more money by growing or by getting better operations, and that gap between operational costs and growth is where all the profit lies. So, last week we were talking about AI and AI optimization and growing your business without your team. Today we're talking about insurance, and I just want to bring more and more ways for you to make more money in this market where actually some businesses aren't growing because they've hit saturation. So Rohit is the founder of Assureful, which is an AI-native insurance underwriter built for e-commerce businesses. Assureful provides pay-as-you-sell product liability insurance using real-time sales data and category-level risk intelligence to underwrite more accurately than traditional models, which at the end of the day means premiums that are the best possible and cover that actually covers you if you have a problem. Rohit also has a deep experience in the intersection of e-commerce and insurance. And before Assureful, he scaled 5 brands from 50K to 35 million in annual sales in 5 years, which is super impressive. So Rohit, welcome to the show.
Thanks for having me, John.
You are very welcome. So, insurance, my favorite topic. Why should we even bother with insurance, Rohit?
Well, there are a couple of things to think about here. Number one, it's mandatory, right? So the marketplaces, you have to have it. It's not just that you have to have it because you should have it, which you should, but more importantly, the marketplaces require it. All retailers require it, and especially Amazon. And we have seen a lot of instances of sellers getting suspended for the lack of insurance. And Amazon just comes in and sweeps up all the sellers if they get a claim in a certain category. And to be honest, you should have insurance. It's the right thing to do as a business owner.
Yeah, I'd agree with that. On top of that, I've had insurance for a decade. I've never used it, which I guess is a good thing. But you were telling me before when we talked about this, actually insurance usage is quite high. Like what percentage does, when you're quoting on insurance, do you actually expect that will claim at some point in the life of their policy or the life of their business?
So think of it this way. In the US, the average net loss ratio for an insurance company is 114%. What does that mean in practice? That means that for every $100 the insurer collects, they pay out $114. So, especially with this product, which is product liability insurance. Now you might ask, well, if they're losing money on every $100, why do they do it, right? Well, they do it because very often it's what's known as a loss leader, right? So you make a loss on it, but then secondarily, it's not just your underwriting profit. And maybe I'm getting a bit too technical here, but you also invest that money in the markets and make a return on it. And so that's how you make 1% to 2% as a tiny profit on the back end. But you are expecting to pay out everything that you collect in premiums.
Wow, that's crazy. I mean, personally, I'm very glad that I'm not an insurer and that you are. But insurance types, you said private, product liability. Like, what are the types of insurance that sellers should be thinking about? What do they need? What's optional? Can you take us through?
Sure. So a lot of sellers are, when they deal with a broker, for example, and there's lots of brokers in the market. We're not a broker. We underwrite the insurance. But when they deal with brokers, typically, sorry?
What does underwriting mean, just for the audience out there?
Underwriting means that we would decide on what risk we're willing to take. So we decide whether the product is insurable and at what price. So that's our decision. So a broker would bring a business to us to make a decision on it. And When we deal direct with customers, we just pass on the cost savings to the customer instead of them going through a broker and paying 15 odd percent higher in premiums. But coming back to what I was saying, when the key distinction is that when brokers take businesses to the market and deal with our competitors, small businesses are typically sold what's known as a business owner's packaged policy, BOP. And that is a bunch of things that most e-commerce businesses don't need, all packaged into one. As an example, the vast majority of our customer base don't have warehouses. They don't hold inventory and have staff managing warehouses. They use 3PLs, they use FBA, they use WFS, which is Walmart's own thing. And increasingly we're seeing they're using, TikTok Shop's own, fulfillment service. And so when they don't have their own warehouses, why are they paying for slips, trips, and falls in a warehouse that they don't have? And so there are a lot of things that e-commerce businesses are sold that they don't need and that they're overpaying for. Case in point, when I was running my own Amazon businesses, we had a 10 million per occurrence insurance policy. And to be honest, at the time, I had no idea what I was looking at, right? The broker said, this is what you need to have, and this is how much you need to pay, which in my case was $100,000 for one of my businesses. And we just paid it because we said, oh, that's what Amazon wants. The reality is that Amazon only wants $1 million and Walmart wants $2 million. But very often we see that brokers, and I need to caveat this by saying we partner with a lot of brokers, so maybe I'm not being entirely fair with them, but they receive commissions based on how much you pay. Yeah. And we don't look at, we're trying to sell insurance at the cheapest rate possible. And so on average, we are 42% cheaper than the rest of the market, which is a huge number. And then you add on to that we also do native monthly billing. So we're monthly billed and usage based. And so you can pay monthly without premium financing. Premium financing alone adds on another 7 to 25% APR on top of your premiums. So we're saving sellers a bunch of money when they switch to us.
That's awesome. So just to clarify, because a lot of people won't understand that, so insurance premium policies, apart from you, are pretty much always sold as annual. And if you choose to pay monthly, you're actually just using a finance product, basically. Like you're borrowing money at 7 to 25% over that year, and that's what they do. So they just jack it up.
That's right. That's exactly right. And so I know of one insurer who will sell an annual policy but allow you to pay monthly, but the finance is baked into the price. All insurance is typically sold on an annual basis. We sell an annual policy, but with native monthly billing, which is entirely different from the rest of the market. I know it sounds similar, but it's not. It's hugely different. Where all insurance in the world, you cannot buy insurance for an accident that you've already been in. Does that make sense? And so, I know, otherwise everyone would be buying insurance after the fact. I'm in the hospital about to die and I buy life insurance. That doesn't work. But what we do is that instead of looking at a forward projection of sales, which is what everyone else does, they'll say, what do you sell and how much of it are you going to sell in the next 12 months? Yeah. And then they give you an insurance quote based on that. The problem with that is that, as we know from being operators, you and I, and the listeners, 100% of the time your projection is wrong. And it could be wrong slightly, or it could be wrong, greatly. You could either be overconfident and say, I'm going to do, 100 million in sales or 10 million in sales, and you have a bad Prime Day, or you are, run out of inventory, or there's some shipping problems or whatever, and suddenly you're not doing, the 10 million that you thought you'd do, but you've already paid for insurance on the basis of that 10 million, and you're not getting a refund if you don't hit those numbers. Consequently, you could be underconfident and say, I'm going to do 1 million, but end up doing 2. In that case, it's even worse because the last anything above your projection is uninsured, which means any claim that comes out of that is uninsured. Further, if the insurer thinks that you have underdeclared your revenue, and you can look at this in your insurance policy or anyone's insurance policy, there's a clause in there called premium audit, where the insurer will charge you $25,000 to send in an accounting firm to do an audit on your books to see whether you have underreported your revenue. So with all of these things, it's a broken system, right? Every single insurer is running a broken system here. And what we're doing is that we look at your actual sales, your real sales in the last month. And this could be, this was your Prime Day sales, or this was, an off-season sale. And then we rate, price, and underwrite it based on your actual sales. And so you're never overpaying for insurance, ever. You are never underinsured. And the third most important thing over here is that you don't have to tell us when you start selling a new product. So, let's take it back a second. If you're selling spoons on Amazon and you say, I see there's an opportunity with forks as well, and you start selling the forks, you source the forks, brand it, sell it. If something happens, the fork is brittle and it injures somebody, destroys some property, or kills someone, and I know it's far-fetched to say that, but I've seen weird claims come through.
Dangerous. Yeah, I'm sure
Forks. Absolutely. And so then that's uninsured because you didn't tell the insurer that you also sell forks. And in our case, that doesn't happen because we see the fork that you started selling and you can just sell it. So it's kind of click and forget insurance that's fully compliant.
I love it. Awesome. So I love that concept. I wish it had existed in the UK when I was selling products and in the US because it was such a pain for me personally to get insurance. I went to so many brokers and still underwritten by someone that's called China Products in the end, and I don't even know if they were legitimate, but I used them for many years. Luckily, I never had to claim on them.
Yeah.
So what's the difference, or is there a difference between product liability and general liability? Because people go to the brokers and they go, well, you tick all the boxes.
Sure.
And that's a form that isn't designed for e-commerce sellers, and e-commerce isn't even a category on half of those forms because it's not a real business.
It's called retail.
Yeah, exactly. So, what's the difference in these type of things?
It's so interesting that you said e-commerce isn't a category. There's several large insurers in the US who call e-commerce businesses mail order and catalog businesses, right? Because they're still stuck in the 1980s when mail order and catalogs were a thing. But e-commerce isn't even a category. You're right about that. To the question, what's the difference between product liability and general liability?